Welcome to XRP Pro Ledger, and today we need to address something directly before we get into the data, because while retail investors are sleeping through what appears to be a quiet weekend, something is being constructed in the background that most market participants will not understand until Monday morning, and by then the window will have already closed. 144 million XRP has been removed from centralized exchange order books in a single 72-hour window. The ask side of top-tier exchange order books has thinned by 4% in the last 4 hours alone. And a late Friday night leak from Washington, D.C. insiders has confirmed that the Clarity Act Section 6 language, the provision that would legally block the SEC from ever challenging XRP's status again, is now 100% finalized. Stay with this analysis until the end, because the institutional math circulating in private forums right now has calculated a liquidity-adjusted real price between $3.88 and $4.12. And the mechanism producing that number is not speculation. It is arithmetic. Let us establish the psychological framework that this weekend is operating inside, because the retail interpretation of market silence and the institutional interpretation of market silence are two completely different readings of the same data. When retail investors look at a weekend chart with low volume and a flat price, they interpret that as an absence of activity. They conclude that nothing is happening. They step away from their screens, disengage from on-chain monitoring tools, and allow the weekend to pass as dead time between two active trading weeks. Institutional desks have a different framework entirely. A weekend with low retail volume and thin exchange order books is not an absence of opportunity. It is the optimal operating environment for automated accumulation systems to move large positions at the lowest possible market impact cost. The silence is not a signal that nothing is happening. The silence is the operational condition that makes what is happening possible. The behavioral pattern playing out right now has a specific name in institutional trading circles: ghost liquidity. The term describes a condition where exchange order books appear to show available supply, but that supply is not genuine resting liquidity available for retail purchase. It is residual thin inventory that has not yet been swept into custody, sitting on the ask side of an order book that has been systematically drained by automated institutional accumulation programs running through the weekend. The 4% thinning of the ask side on top-tier exchanges in the last 4 hours alone is not noise. It is the real-time measurement of ghost liquidity in action. And what the ghost liquidity phenomenon guarantees is mechanical and unavoidable. When Monday morning's US session opens and retail buy-side demand re-enters a market where 144 million tokens have been removed from the available flow, the resulting price discovery does not move gradually. It gaps upward through a supply structure that is no longer there. Now let us address the $3.88 number precisely, because it is the most important output of institutional analysis circulating in private forums this weekend. A technical framework surfacing closed institutional channels has calculated what analysts are calling the liquidity-adjusted real price of XRP, the token price required to facilitate the current $2.10 billion in daily institutional volume on the XRPL without triggering 2% or greater slippage. The math is not complex once the variables are understood. At the current circulating supply and current transaction velocity, settling $2.10 billion in daily institutional flow through the XRP ledger without price impact that degrades the settlement value requires a minimum token price of $3.88. Below that level, the slippage generated by large institutional transactions begins to erode the cost advantage that makes XRPL settlement superior to SWIFT in the first place. This is not a price target. It is the minimum engineering requirement for the use case that institutions are already operating. The $4.12 figure represents a second and independent calculation arriving at a similar structural conclusion from a different analytical direction. A Singapore-based liquidity provider's research note argues that traditional banking rails are currently imposing a hidden tax on the global economy of approximately 2.1% per transaction in combined settlement delays, corresponding banking fees, and float costs. That tax, measured against the volume of global institutional payment flows that are now being evaluated for migration to blockchain settlement infrastructure, represents a cost structure that XRP's sub-cent transaction fees and 3 to 5 second settlement finality eliminates almost entirely. But the math also shows that for XRP to function as that settlement layer without introducing price volatility that recreates the settlement risk it is designed to eliminate, the token's market capitalization must support a unit price of $4.12. David Schwartz confirmed the technical requirement behind this calculation directly. The XRPL's objective is to move value so fast that the price at the start of a transaction and the price at the end are identical. That atomic settlement standard demands a specific price stability threshold that the current price does not yet reflect. The Clarity Act Section 6 leak that surfaced from Washington, D.C. on Friday night is the regulatory development that transforms this weekend from an accumulation window into a structural inflection point. The specific language that has been confirmed as finalized in Section 6 introduces a secondary market safe harbor provision that classifies digital commodities as exempt from the Howey test under specific liquidity conditions. The analytical significance of that language cannot be overstated. The Howey test is the legal framework the SEC has used to assert jurisdiction over digital assets by classifying them as investment contracts as securities. A statutory exemption that removes digital commodities from the Howey test under defined liquidity conditions does not merely reduce regulatory risk for XRP. It legally forecloses the SEC's ability to re-challenge XRP status in any future enforcement action. This is the provision that institutional legal teams have been waiting for before committing full balance sheet capital to XRP positions. The supply data from this weekend, viewed against the backdrop of the Section 6 confirmation, produces a timeline that retail investors are systematically not accounting for. The 144 million XRP removed from centralized exchanges over 72 hours did not disappear randomly. On-chain routing data shows a single transfer of 14.25 million XRP moving from a secondary exchange wallet directly into a cold storage address associated with institutional custody infrastructure, a black hole vault that functions as a long-term balance sheet holding, not a trading position. Reports from institutional custody providers are simultaneously confirming a surge in new account foundations in the UK and Singapore, multi-continental custody infrastructure being established for the XRP positions accumulated this week. These tokens are not being positioned for a short-term trade. They are being vaulted for the regulatory environment that Section 6 is about to formalize. The ETF data adds the final structural dimension to this weekend's accumulation picture. Spot XRP ETF trading is closed over the weekend, but secondary market NAV premiums, the difference between the ETF's net asset value and the price at which shares are trading in after-hour secondary markets, are showing elevated demand signals ahead of the Monday open. Total spot XRP ETF AUM is holding at the record $1.61 billion level, despite the weekend closure of primary market creation and redemption mechanisms. That stability at record AUM, combined with elevated NAV premiums, tells institutional portfolio managers exactly what the Monday open order flow will look like. When primary market mechanisms reopen on Monday and authorized participants begin processing the weekend's accumulated demand into new ETF share creation, the underlying XRP purchase pressure that creation process generates will enter a market where 144 million tokens have already been removed from the available float. The mechanics of that interaction are not ambiguous. The ecosystem developments unfolding in parallel with the accumulation and regulatory picture confirm that the institutional thesis is being built on operational infrastructure rather than speculative positioning. The RLUSD 105% Treasury collateralization rule is now generating a $4.80 million weekly interest surplus capital that is being deployed into a market maker incentive program designed to ensure deep continuous liquidity for XRP and RLUSD trading pairs across global venues. This is not a marketing program. It is a structural intervention in XRP's liquidity profile, funded by U.S. Treasury yield, designed to eliminate the thin order book conditions that create settlement volatility. The mechanism effectively uses Federal Reserve rate policy to subsidize the liquidity depth that institutional settlement requires. And it compounds weekly, expanding the war chest available for liquidity provision with every passing interest payment cycle. The institutional DeFi gateway that launched its private beta at 4:45 p.m. BST today adds a capital flow dimension that most retail observers have not yet registered. A major XRPL-based protocol opened a KYC-only liquidity pool, structured specifically for private wealth office access, with minimum deposit thresholds and regulatory compliance requirements that exclude retail participation entirely. In the hours since launch, private wealth desks have committed $9.50 million in XRP to secure yield within a regulatory compliant framework. $9.5 million from institutional wealth managers entering a single private pool in under 3 hours on a Saturday afternoon while retail investors are disengaged from the market. That velocity of institutional capital commitment is the clearest available signal that the entities with access to the Section 6 leak, the $3.88 liquidity math, and the custody accumulation data are not waiting for Monday's public confirmation to build their positions. The picture that emerges from tonight's data, assembled with precision, is the following. 144 million XRP has been removed from exchange order books in 72 hours through automated institutional accumulation. The ask side of the remaining order book has thinned by 4%, creating ghost liquidity conditions that guarantee upward slippage when Monday's retail demand re-enters the market. Private institutional forums have calculated a liquidity-adjusted real price between $3.88 and $4.12 based on current XRPL transaction volume requirements. David Schwartz has confirmed the atomic settlement standard that drives that repricing requirement. The Clarity Act Section 6 language, the silver bullet that legally blocks the SEC from re-challenging XRP, is confirmed as finalized. The RLUSD war chest is generating $4.80 million weekly to fund market maker debt, and $9.50 million in private wealth capital entered a KYC-only institutional pool in under 3 hours today. The retail investor who believes this weekend is quiet is reading the headline. The investors who found the footnote are already positioned. If this analysis changed how you're thinking about XRP, hit like and subscribe. I drop deep dive breakdowns like this twice a day to keep you ahead of the market.